All right, class, settle down. Let's talk about something you hear about on the news all the time, IPOs.
What in the world is an IPO?
It stands for Initial Public Offering. Think of it this way. A private company, like your favorite new coffee shop that's suddenly everywhere, decides it wants to grow even bigger. To do that, it needs a lot of money. So for the very first time, it decides to sell little pieces of itself called shares, stocks. You, me, anyone can buy a piece when it debuts. That first sale is the IPO. It's like the company is having its big debut party, and you're invited to buy a ticket, which is a share. Getting in on an IPO can feel like discovering a rock band before they become famous. If the company does well, that piece can go up and up. But I need you to hear me clearly on this. It is not a guaranteed win. It is a risk. That company is new to the public market. We don't have a long history of its stock performance to look at. You are betting on its future potential based on what you know about its business today. Now, if IPOs feel like jumping into the deep end, let's talk about wading into the pool. This is where mutual funds come in. A mutual fund is like a big basket. A professional money manager takes money from thousands of investors and puts it together. They buy stocks, bonds, and other assets. So buying one unit gives you tiny pieces of everything inside that basket. It's diversification made simple. It spreads out your risk. If one company in the basket doesn't do well, you have dozens or hundreds others that might be doing great. It's like having a whole team instead of one star player. Mutual funds come in all shapes. Tech funds, international, bond funds, goal-based funds for retirement, home, education. There is a fund for almost every goal. This is a foundational strategy for building long-term wealth. You are not putting all your eggs in one basket. This brings us to a beautiful, simple tool called a SIP, or Systematic Investment Plan. A SIP is an instruction to invest a fixed amount into a mutual fund automatically every month. It could be as little as $50 or $100. Think of it like a subscription for your future wealth. It automates investing so you don't have to think about it. The magic of a SIP is dollar cost averaging. When the market is down, you buy more units. When up, you buy fewer. Over time, this smooths your cost and reduces the risk of investing a large sum at the wrong time. It takes the emotion out of investing. Now let's bring in their popular cousin, the ETF, or exchange-traded fund. At first glance, ETFs and mutual funds look very similar. Both are baskets that offer instant diversification. They can hold stocks, bonds, commodities, and are managed by professionals. The big difference is how they are bought and sold. A mutual fund deals at end-of-day NAV. An ETF trades intraday like a stock. You buy/sell anytime the market is open. An ETF's price can change minute to minute based on supply and demand, giving you control and visibility over the price you pay. ETFs, especially passive index ETFs, tend to have lower expense ratios because they often just mirror an index. Actively managed mutual funds have higher fees to pay managers trying to beat the market. Which one is right? If you're hands-off and long-term with a SIP, a mutual fund is great. If you want intraday flexibility and lowest costs, consider ETFs. Many investors use both. Understand how each tool works so you can choose the right one for the right job in your financial toolbox. Let's talk about a powerful trend that is changing investing. It's called ESG investing. ESG stands for Environmental Social Governance. The E is about stewardship of the natural world, carbon footprint, renewables, sustainable agriculture. The S looks at how a company treats employees, suppliers, customers, and communities. Fair labor, diversity, inclusion. The G is governance. How the company is run, leadership accountability, checks to prevent fraud and corruption. Some say you must choose between profit and purpose. That's a false choice. Companies with strong ESG practices are often better managed, more innovative, and more resilient. There are now thousands of mutual funds and ETFs designed around ESG principles. These funds screen companies based on ESG scores and do the research for you. You can pick a broad ESG fund or a theme like clean energy or gender equality. By choosing ESG, you are voting with your dollars. telling companies you want them to be better. It's not just good for the world, it can be good for your portfolio too. Okay, let's talk about the one thing nobody loves but everyone must deal with: taxes. You cannot build wealth without understanding how taxes work. Ignoring it is like trying to fill a bucket with a hole in it. When you invest, there are two main taxes: on dividends and on capital gains. Dividends are small payments some companies give to shareholders. Capital gain is the profit when you sell for more than you paid. Example: buy at $100, sell at $150. That's a $50 capital gain. Crucial: tax depends on how long you held it. Held 1 year or less? Short-term capital gain taxed at your income rate. Held more than a year? Long-term gain taxed at a lower rate. True investing is a long-term game. Patience is not just a virtue, it's a tax-saving strategy. Day traders often pay high short-term taxes repeatedly. Long-term holders are rewarded. Good news: special accounts can shelter money from taxes. 401(k)s, traditional and Roth IRAs. Traditional gives a tax deduction now. Roth uses after-tax dollars and grows tax-free. Qualified withdrawals are tax-free. Use these accounts. We have covered a lot today. I want to tell you a story about a young woman named Anya. When Anya graduated and started her first job, her finances were a mess. She was living paycheck to paycheck, had student loans, and investing felt for rich people. The stock market seemed like a scary casino. She heard words like ETF, IPO, 401(k), and shut down, overwhelmed, anxious, powerless. One day Anya decided she was tired of feeling afraid. She realized her fear came from lack of knowledge. So she made a decision: she would learn. She started small, reading articles, listening to podcasts, borrowing books. Slow, piece by piece, the language began to make sense. A mutual fund wasn't a monster. A SIP wasn't a complex algorithm. Her first step was opening a Roth IRA and investing just $50 into a low-cost S&P 500 index fund. It wasn't much, but it was monumental. She set up a SIP of $100/month. Sometimes it went down, but over time it trended up. That small win gave her confidence. When her company offered a 401(k) match, she knew exactly what to do and signed up immediately. Free money. A few years later, Anya is more confident. She tracks net worth, increases contributions with raises, and the fear is gone, replaced by control and optimism. Your first step? Open that IRA, sign up for your 401(k), read another article, finish a finance book. Whatever it is, do it now, today. The single most important factor is time. The sooner you start, the more time your money has to work via compound interest. Smart investors are educated, patient, disciplined. They have a plan and stick to it. They understand tools and use them wisely. Financial literacy is the key that unlocks financial freedom. You become the architect of your future. The power to say no, the power to say yes to your dreams. Go out there, get educated, take control. Don't just invest, invest smart.